Right now, REITs are still priced at a decade-low valuation. They've dropped by 25% on average, even as their cash flows have grown by about 10%, which essentially means that their valuations have dropped by a third compared to just a few years ago. As a result of this, REITs are now the cheapest in over a decade relative to other stocks like in the S&P 500. I'll put a chart on the screen and you'll see there that there's only been 2 times where REITs were this cheap. It was during the dot-com bubble as well as after the great financial crisis. And in both cases, REITs massively outperformed in the following years. I'll put again charts on the screen. You'll see that following the great financial crisis, REITs more than tripled in value in just a few years. I think that we'll see a repeat of that in the coming years because REITs are once again priced at such low valuation that management teams are aggressively buying back shares, and even private equity players like Blackstone are now accumulating REITs hand over fist. But not all REITs are equally attractive, and in today's video we're going to discuss 3 once-in-a-decade investment opportunities that we expect to surge in value in the coming years. Hey, this is Yossi. I run a small investment firm that specializes in REIT investing. In today's video I'm going to discuss 3 of our favorite REITs to buy for 2025. But before I get into it, I wanted to remind you that we just recently launched our Black Friday sale. It will still run for a few days. This will give you the chance to join our REIT newsletter, High Yield Landlord, with a deeply discounted rate, as well as a 2-week free trial. This means that you will gain immediate access to my portfolio, all my transactions, my CEO interviews, a course to REIT investing, and much more, completely risk-free for the first 14 days. You won't be charged anything, and then if you decide to stick with us for the long run, you'll be charged on the 15th day the annual membership with a deeply discounted rate. So the first REIT I'm going to discuss is called Ryokan. Its ticker symbol is REI.UN, and this is a retail REIT that operates in Canada. Right now, Blackstone is attempting to buy out Retail Opportunity, which is another retail REIT that owns strip centers in supply-constrained markets. Such properties are doing really well because they enjoy very favorable demand-supply dynamics and can easily pass on the inflation to their tenants, resulting in rapid rent growth at the moment. Retail Opportunity is today trading at 16 times FFO, and Blackstone still thinks that it's getting a good deal. So much so that they're attempting to acquire the whole company and likely will pay a substantial premium for it. In case you're not familiar with Blackstone, it's the biggest and most sophisticated private landlord in the world. They have an amazing track record of buying real estate at cheap valuations, making improvements, and then reselling it for large profits. Well, we think that Ryokan owns even better assets than Retail Opportunity, and yet it's today trading at 11 times FFO, which is a steep discount relative to it. We think that this discount is not because of fundamental reasons, but rather because it's a Canadian REIT and it's today ignored by most investors. It owns mainly service-oriented essential retail properties in prime locations of Toronto and other major cities that enjoy some of the fastest growth in G7 countries. But despite this rapidly growing demand, the growth of supply is strictly limited by the lack of available land and the high construction cost, resulting in strong rent growth. Today, Ryokan's rents are $22 per square foot on average, by signing new leases at closer to $27, meaning that its leases are deeply below market, giving Ryokan an opportunity to significantly bump up its rents as its leases expire. We think that this positions the REIT for strong growth in the coming years and also significant organic deleveraging in the process. I expect this to create about 5% of value annually, and you also earn a 6% dividend yield on top of that while you wait, and this dividend is paid on a monthly basis. But the real kicker here is the upside to fair value. The REIT is today trading at a much lower valuation than most of its weaker American peers. Its US peers like Retail Opportunity, Federal Realty Trust, Regency Centers, Brixmor Property Group have all surged in value as the Fed cut interest rates and the attention turned to their strong rent growth, but Ryokan somehow missed out on this rally. The interesting thing here is that Canada even has lower interest rates, and their central bank has been even more aggressive than the Fed in cutting them. So all else held equal, Ryokan should have surged even more by now, but since it didn't, it remains very opportunistic. We believe that the delay in market reaction here is due to the fact that Canadian REIT investors are much more passive than American REIT investors, but eventually we expect the valuation gap to close, and this has the potential to unlock about 40% upside potential. And if the gap does not close naturally, I would not be surprised if a Blackstone-like company eventually made an offer to buy the entire company. And therefore, we really like the opportunity here. We own prime real estate in Toronto and other major Canadian markets. We get a high 6% dividend yield. We expect about 5% annual growth, and there is significant upside to fair value. And for all these reasons, Ryokan is one of our largest holdings in our international portfolio at High Yield Landlord. As I mentioned earlier, if you want to access the full portfolio, we're offering a 2-week free trial at the moment. Then the second REIT that I also think is a once-in-a-decade buying opportunity is First Industrial Realty Trust, ticker symbol FR. On the surface, First Industrial may not seem particularly cheap, trading at 18.5 times FFO. That's roughly in line with the averages of the REIT sector, but here it's important that you consider that these surface level metrics like FFO are missing some key elements. Firstly, First Industrial owns mostly Tier 1 industrial properties in supply-constrained markets, and their leases are deeply below market, allowing First Industrial to significantly bump up its rents by 40 to 50% as its leases gradually expire. Today, its average remaining lease term is only 4 years, and therefore we are very confident that the REIT will see rapid rent growth in the coming years. Then secondly, the REIT owns a large land bank that is not today generating any cash flow, but it holds significant value. The REIT has a great track record of developing new properties and earning a 7 to 8% initial yield, resulting in a very large spread of its cost of capital. This positions First Industrial for further growth in the coming years as it builds additional properties. So this explains why First Industrial has commonly traded at closer to 30 times FFO in recent years. The market has been willing to pay this high multiple because it knows that its current lease rates are far below market, and the REIT also owns a significant land bank. But now more recently, the market has grown increasingly impatient and the focus has shifted to interest rates, and this has caused its valuation to crash. As a result, it now trades at just 18.5 times FFO, but this is simply too low in our opinion, because if you adjust for its rents to be 30 to 50% higher and you unlock the value of its land bank, then the company's valuation multiple would drop excessively low for a REIT with such rapid growth prospects and such high quality properties. Rather, we think it's more likely that the company's share price will adjust materially higher in the coming years as its leases are bumped up, resulting in significant upside for shareholders who buy today. We think that the upside potential is anywhere between 30 and 50%, and while you wait, you're earning a 3.5% dividend yield. Yes, the yield may seem low, but remember what we said earlier. The lease rates are today deeply below market, and on top of that, they retain about 40% of their cash flow to build new properties. So in a nutshell here, we think that a lot of value is hidden by the fact that its lease rates are deeply below market and it owns a lot of land that's not yet generating any cash flow, but all of this will change completely over the next few years, and therefore we think that this is a great opportunity for investors who can think long-term and forget about the short-term disruption caused by the rising interest rates. Hey, before I come to the second REIT, can you please do me a huge favor and click the like button if you enjoy this type of content? It helps me a lot to keep on growing and I appreciate it. Thank you so much. Now the third REIT I'm going to discuss is called BSR REIT. Its ticker symbol is HOM.U in Canada and BSRTF in the US. BSR REIT is a small REIT that owns apartment communities mostly in the Texan Triangle of Austin, Dallas, and Houston. It's today one of our largest apartment REIT holdings at High Yield Landlord because we think that its markets will enjoy some of the fastest rent growth of the coming decade. Then on top of that, it's today trading at one of the largest discounts to its net asset value in its peer group compared to companies like Mid-America Apartment Communities and Camden Property Trust. And then thirdly, the management is very aggressively buying back shares today to unlock value for its shareholders. I had taken a break from buying BSR in recent months because it had recovered quite a bit and its discount to NAV had compressed, but recently it dipped again and it has now become opportunistic once more. Its discount to NAV has now expanded back to around 30% and the management is busy buying back shares at about 70 cents on the dollar, and as interest rates now return to lower levels and rent growth accelerates in 2025, we expect the market to reprice the company at closer to its NAV, and this has the potential to unlock about 40% upside from here. While we wait, we earn a 4.5% dividend yield that's paid on a monthly basis, and the company keeps creating further value by buying back shares and growing its rents. And this is ultimately why we are today accumulating REITs. They're essentially allowing us to buy high-quality real estate that's professionally managed, diversified, and liquid at a very large discount relative to what we'll be paying in the private market. BSR REIT is a good example of that, but there are many more such opportunities in the REIT sector. And if you want to access my full portfolio, you can join High Yield Landlord for a 2-week free trial. It will be the first link in the description of this video. As soon as you join, you also gain immediate access to exclusive CEO interviews, including with the CEO of BSR REIT. Let me know in the comment section below which REIT do you prefer out of the 3 that I discussed in this video. Please once more click the like button, that helps me a lot. Thanks so much and see you at my next one. Bye bye.